All right, now that we've learned about auto loans, we're going to learn about some home loans. Those are also known as mortgage loans. So if you'll hear me call it home loans or mortgage loans intermittently, it means the same thing. First thing is the process. So step one, you're going to seek pre-qualification or pre-approval. This will allow you to see your credit score, how much money the bank will be lending you. You're going to need tax information, credit score, proof of current employment, income, and proof of savings. There's also some other things they're going to need, but your loan officer at the bank will help you with that process. Your pre-qualification or pre-approval has to be done before you can even look at a house anymore. That just means that you go through the process to show that the bank trusts you with money before you go look at somebody's house that they're trying to sell. Okay, once you have gotten your pre-approval, you need to know the different types of loan options because there's not just one type of loan, there are many types of loans out there. So that's what we're going to talk about next. The type of home loans are vast, so I'm only going to talk to you about a few of them. The first one is a conventional loan. It is a loan that is not insured by the federal government, so you're required to pay extra insurance called private mortgage insurance or PMI. This is a typical loan. This is what a lot of people get. You get this loan and you have to pay extra on it. So I have this type of loan and I have to pay on it. I think it is an extra like $65 a month on my loan. And what that is if something was to happen to my house, so if the house was to burn down, basically my insurance would cover it, but also my private mortgage insurance would cover anything that my other insurance did not cover. This is it's kind of an interesting concept, but once you have 20% of your house paid off, you do not have to pay PMI insurance anymore. The next type of loan is the Federal Housing Administration loan, also known as an FHA loan. These type of home loans help make ownership possible for borrowers who don't have a big down payment saved up and maybe don't have the most excellent credit. You need a minimum score of 580 to get the FHA loan, and it is only for first-time home buyers. So this is a little bit more relaxed of a loan, but again, it is only for first-time buyers, and the percentage of the interest rate is higher than this one. The next type of loan is the U.S. Department of Agriculture loan, so that is the USDA loan. And these loans help moderate to low income borrowers buy homes in rural areas. So that would be somebody in a country setting who perhaps doesn't have a super high income, but they want to purchase a home. So that would be the U.S. Department of Agriculture loan. The next type of loan is the Department of Veteran Affairs loan, also known as a VA loan by most people. This provides flexible, low-interest mortgages for members of the U.S. military, both active duty and veterans and their families. VA loans do not require a down payment or that PMI I was talking about up here, that private mortgage insurance. And typically closing costs are generally capped and could be paid by the seller. So this is a loan set up to help veterans or military families buy homes. Now, within those type of loans, there are different types of those loans. I know that's kind of confusing, but there are fixed rate loans, which means a fixed rate mortgage is where you keep the same interest rate over the life of your loan, which means your monthly payment always stays the same. Your home loan usually comes in 15, 20, or 30-year increments. This is good because if you start off with a very low interest rate, and then you have that low interest rate for your entire loan, that saves you money. What this becomes a problem is when you start off with a really high interest rate and then the interest rates drop. You do not get to drop your interest rate. You have to stay at that high rate, meaning you're paying more money for your house than other people are at that time. Because of that, they now also have adjustable rate loans. Adjustable rate loans have fluctuating interest rates. Their interest rate goes up and down depending on what the government interest rates are at the time. So that means your payment goes up and down depending on the current interest rate set by that government. So that's good and bad. It's good because there will be times where your payment will be much lower, but It's bad because there's times where your payment will be much higher. Another type of loan is if you're going to build a home, it's called a construction loan. A construction loan can be good if you're building a home. You can decide to get a separate construction loan for the project and then a separate mortgage, or some banks let you get a construction loan that converts into a mortgage. I'm currently going through this with my new build that I'm constructing, or we're going to be constructing, hopefully starting in March or April. We get a construction loan for the amount of the house, and then they use that loan to build the home, and then once it is finished, it converts into a mortgage, a conventional mortgage, which is what I talked about on the previous slide, where we just start paying payments on that mortgage. I believe that mine is also a fixed rate mortgage since interest rates are very low right now. So once you have decided what type of loan that you're going to get, you can begin looking for your home. You must look for a home that falls within your price range, and that is set by your pre-approval from the bank, which is step one. So if they pre-approve you for a loan of $200,000, you are not or should not be looking at $300,000 homes unless you have $100,000 cash saved up. You need to stay within your price range so that way you're not stretching yourself, or that you won't get into some trouble where you accept an offer on a house that you cannot afford. Step 4, once you find that wonderful house that you're going to live in, you're going to make an offer on that house. You and your realtor will most likely work together to come up with an offer on the home. Sometimes you make an offer below what they're asking. Sometimes you offer exactly what they're asking. And other times you offer a little higher, especially if the market is competitive. For example, right now we are in a very competitive market where people are really after buying homes. So if the house is offering at $200,000, it may be in your best interest, if a lot of people are looking at the house, to offer $205,000 or $210,000. To ask over asking price, so that way your offer looks better than other people's. Now, in other markets, when houses are not selling as well, people tend to ask below, because nobody is looking at someone's house and you're the only offer. You want to get the best deal possible. Step 5, once you've made an offer, and it's been accepted, you're going to continue to move forward with the bank. They're going to help you calculate your down payment, your monthly payment, and all of your loan terms, which we've already talked about. And now in your pre-approval, they will do this, but in step 5, they really cement this and give you exact numbers. Something I did want to talk to you about is there are different types of mortgage lengths or terms. So the 15-year mortgage or 30-year mortgage. Now, I'm not telling you what to do. It is up to you. And when you're an adult, you have to make informed decisions with your spouse or by yourself. That is best for your family. But I am here just to show you the truth or the facts of things. If you're buying a home for $250,000 and you have a $25,000 down payment, that leaves you with a mortgage amount of $225,000. Now, let's look at the 30-year versus the 15-year mortgage. If you took out a 30-year mortgage and paid payments on that for $1,349 a month for 30 years, after 30 years, paying off the house and the interest, you would have paid $485,000 back to the bank. That's quite a lot. If you chose a 15-year mortgage, your monthly payment is $1,899 a month, which is a little higher than the $1,349. But after the 15 years, you've only paid back $341,000 to the bank instead of the $485,000. If you do the math here, that's saving you almost $144,000, and you've paid your loan off in half of the time, which means you spend 15 extra years without a house payment. On paper, this is wonderful, and if you can do this, I highly suggest it. It's not always feasible for everybody, but I wanted you to know what's out there and why some people do choose the 15 over the 30-year mortgage. So those are home loans and different types. If you need to review this video, I know there was a lot of information. Please feel free to do so, and have a good day.